In this video, I will be showing you 4 types of liquidity and how you can trade them. The first one is equal high and equal low liquidity. The second one is structural liquidity. The third one is entry zone liquidity. This one is my favorite, like it works all the time. The fourth one is order block or fair value gap liquidity. Now, for those who doesn't know what liquidity is, have you ever taken a trade just after you tap your stop loss, you went straight to your take profit? Yeah, it's painful, and that is liquidity. So there is something important about liquidity. Liquidity does not only take your stop loss, it's also important and it helps you understand where market is likely to go next. I will show you how to take advantage of that and reduce your stop loss and reduce your losses in trading. So let's go straight to the video. So the first thing we'll be looking at is the equal high and equal low liquidity. Now, I wrote something on my notes and this helps me to follow the rules that I have back tested a strategy that works. So I will be reading it aloud before I now look into it on the chart. So according to what I wrote here in my book, as my rule, the first thing I wrote here is if a market has an equal high or equal low without a structural liquidity, the equal low or equal high becomes the liquidity. So I will show you exactly this thing I just mentioned right here on the chart so you can understand that. So this pair right here is GVP JPY. Now, as you can see, we are obviously bullish. All right, meaning that market is breaking structure to the upside. So this was the low right here. This is the low that led to this high, and now we have a new low that led to this breakup structure right here. Okay, so this is what is going on. Now, what happened is that we now have an equal low right here. We have equal low. All right. So now we have equal low. What usually happens is this. So people have seen that we have equal low. This is equal low liquidity loading right here. And now maybe you were waiting to see like a breakup structure right here. Now let's see what happened after. So now we have seen a breakup structure. So the thing that usually comes in mind is you wanting to take this trade from this other block right here and stop loss. Let's see what happens. Stop loss probably below this one right here, and you are targeting above maybe 1 to 3 or whatever. Or according to what we have in our notice, if an equal high and equal low doesn't have a structural liquidity, the low becomes the liquidity. So let's see what happens eventually. So market initially look as if it was nice right here, like looking like you are right, and all of a sudden, boom, this happened. Why is that? We don't have a structural liquidity. So this low right here becomes the liquidity. So market take out this low as the structural liquidity, and then this other block right here becomes the entry. You were not wrong, but you were just at the right, you were just in at the wrong time. So assuming you took this trade right here below this zone, okay, knowing that now you don't have a structural liquidity and you target above this high, would have been good. Now let's see what eventually happened after we have the structural liquidity. Are you seeing that right there? And then boom, there you have a take profit. You see that? Just simple change. If you don't have a liquidity, do not trade. So when you have an equal low, the first question you should always ask yourself is, do we have a liquidity? Is my stop loss going to be a liquidity? So this is it right here. Now we'll be going to The second one, which is structural liquidity. So let's go to the chart. So I'll show you structural liquidity. All right. So the second one is structural liquidity. And also I have something that I wrote here on my notes concerning a traded structural liquidity. These are for SMC traders. Now, what I wrote here is when a market sweep a previous high and break a structure, if that move or the market has a structural liquidity, the high are more likely to be protected. All right, that is the first rule. Then the second rule is that if that market doesn't have a structural liquidity, the high becomes the liquidity. So let's go straight to the chart. So I will show you exactly what I just read out here and how you can understand it. So this is GBP USD. All right. The first thing you should observe is market is obviously bearish, meaning that we are selling, dumping to the downside. We are seeing a break to the downside. All right. Very, very important. Now, while we are selling to the downside, you notice something right here. When a price break took out a high, see that we had a high, which is a sweep. All right. Now, the next thing we want to pay attention to is to know if we took out the low as well. So when a market breaks sweep a high and break a low, if it has a structural liquidity, that high is more likely to hold. All right. Now, let's see what happened next. Boom, 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 boom. And then boom, we have a break of structure. All right. Now, as you can see, this time around, after we had this break, we had a structure form before this break. What happened is that many people are more likely to focus on this right here, forgetting that the initial move that caused this break of structure was not this high. It was this high. That is where we had a sweep and a break. Now, there are two ways structural liquidity could form using this strategy. It happens either before the break or after the break. Let me show you something right here. So it's either happen maybe a sweep, a break of structure, structural liquidity, and another break. Then you have price pullback, taking out this structural liquidity, and then continue to the downside right here. So this becomes the structural liquidity right here. Structural liquidity. It's quite small, or you get the point. So this is the structural liquidity, and then you had your first break right here, which was a sweep. Let's say it was a sweep from a previous high right here. Okay. So you had your sweep of the previous high. You had your sweep from the previous high, and now you have a break of structure, and then price pullback to form a structural liquidity, and then break another structure right here. Okay. Now, what happened is that when market pull back, because some people, because they have seen that, okay, when market pull back here, we sold off. So what they are expecting is market to also pull back here and sold off. This is how we were taught initially, that this is how market move: higher, high, higher, low, higher. But that's not true. There are many things happening right now at the chart. So because here is the structural liquidity, and now you took your trade here, right here, and market happens to take out this high, you have taken your first loss. You were not wrong, it's just that you were in the market at the wrong time. You didn't know what was going on the chart, and then you end up taking loss. Yet market still goes according to what you initially expected. See, this is the first type. This is the first type. All right. And then let's look at the second type. The second type is, let's say this was a high and market swept this high. Now, instead of breaking structure right away, we had a form of a little consolidation or a structure, and then we now break structure. Okay, so now we have first a structural liquidity. Sorry, a sweep. I don't know why I keep calling this in a structural liquidity. So we have a sweep. Now we have a structural liquidity, meaning that price formed another high before we break structure right here. Okay, so what usually happens is price pull back, take out this last high right here, triggering our entry, and then sell off. So this is the two type of structural liquidity trading. You see that? You are not wrong if you had your entry right here, but you are just too early on the chart. So this is usually the two type of structural liquidity. Let's go back to the chart. So now, as you can see, according to what we are seeing here, it's looking similarly like this one right here. Okay, now we have seen a sweep, a structural liquidity, and a break. What does this tell us? We need an entry, meaning that immediately my mind have told me this high right here has to go. So this high is my structural liquidity. Okay, so all you have to do is wait for price to take out this high, and then you have your entry. Okay, now let's see what eventually happened. So you can see price dancing around and then pulling here. This is the tricky part. When market gets in here, you can tell that this is where you start having like a double mindset. You start having this doubt on your head. Okay, now in your mind, you are saying that, okay, this high, we have a sweep, we have a break, this should be it. So now you took your sell right here, stop loss above this high, or you have forgotten one thing. When a market sweep a high and break structure, if you have a structural liquidity, that high is more likely to hold. This is not that high they are talking about. This is the high that swept here before it breaks. So you have your stop loss right here, and now you have probably your TP below this level. Let's see what happened. Okay, it's looking like you are in profit. Let's see. Let's keep going. And then just like that, boom, you just took a loss. Initially you were happy thinking that we are doing great, and then suddenly now you are out of the market after seeing profit, and this is the most painful part. And now see what happened. You see how price pull back to this high, taking out the structural liquidity. So if I was to be in this chart, this would have been my entry and not this one right here. So I'll have my stop above this high and then have my target this low. Very safe, 1 to 5 this time around. So let's see what eventually happened. Just like that, we are on profit. Okay, keep going, and then boom, we are TP smash. Just using this simple strategy: a sweep, a break of structural liquidity, and then boom, you have a TP. So this is the structural liquidity pattern. And if you want me to make a video of how to use this particular SMC structural liquidity pattern, comment it on this. If you want me to make video how to use this particular strategy, just drop me a comment on the comment section, and I will make a different video explaining these two exact pattern and how to use them on every single pair. Like, it works on almost all the pairs I have tested so far. Okay, so now let's talk about my favorite, which is the entry zone or demand zone liquidity. This one is my favorite. So according to what I wrote here on my note, entry zone liquidity is the manipulation of the demand zone liquidity. So let's see what I'm trying to say right here on the chart. Now, this is BTC USD. Like, I like using this strategy on BTC. It works on USD, GBP USD, as well as there are some other pair that it works on, but I noticed like it's more effective on BTC. All right. So this what usually happens on the chart. So on the demand zone or entry zone, because the reason why I call it entry zone, because this is where many people, both from buyers and the sellers, are looking to take their entry. All right. So either sellers want to sell or buyers want to buy, but it has to happen at that demand zone. Now, I take advantage, or I will show you how you can take advantage of the demand zone to know where market is more likely to go. So you just have to go with it, manipulation, and then pay to trade. All right. So now, what usually happens when markets approach a demand zone is that you start seeing a slowdown. So let's say we are having a massive buy to the upside, and all of a sudden you start seeing a slowdown in market move. This is where you should be careful. All right. When you start seeing a sudden slowdown when market is approaching a demand zone, there has to be this one last push. I want you to go through all the pairs, check when price approach the demand zone. There's always this slowdown and then one last push before the sell happen. And that one last push is what I'll be showing you how to trade it. All right. So let's say you start seeing a slowdown right here in the chart, and all of a sudden you see something like that, and then boom, this high is gone. Even if we are to sell, or we have to grab this liquidity for sure at this zone before you start seeing the reversal pattern. So let me show you this thing on the chart right here. Now you can see like BTC, while approaching this demand zone, you can see that we have this consistency of price moving the same exact way. And then suddenly we start having this rejection right here. This is the first manipulation right here. Okay, so when you see this thing right here, trust me, a lot of people are going to sell from here. Sell for sure, guarantee. Why is that? Because they have seen a slowdown and they saw the rejection if they didn't even take the trade at the first rejection, and now they see the second rejection and this huge sell, massive sell to the downside. All right, this first candle drop, but this is where we want to make money from. We have to go with the trend, go with the chart. We don't have to, like, there's one thing I always say: forget what you know and trade what you see. All right. So once price approach on a demand zone, the first thing I always look at is, do we have an equal low? This is where equal low plays a good role. So boom. And I usually use a lower time frame for this because it doesn't go too far most times. So lower time frame is the best to like catch 1 to 3 or 1 to 4 using this particular strategy. So this on the 5 minutes, I want to see, first thing I want to see is an equal low when price is approaching a demand zone. This is where the trick is. Now, as you can see right here, we have an equal low, sign 1. Now, after we had that equal low, I was okay, fine. Some is getting interesting. We have equal low 1. I want to see a break of structure. It's quite similar with the structural liquidity pattern, but this one consists of using equal low with a liquidity and then go with the trend to take out the sell liquidity. I know it sounded crazy, but you will get it eventually. So the first thing you need to look for is an equal low, and then you need a break of that low, that high. All right, that high that led to the second equal low, you need to see a break. Okay, now you need to see a break of that high. The next thing, remember what I said initially. If a low doesn't have a liquidity, if a move, and if an equal low doesn't have a liquidity, that low becomes liquidity. So now we have a break and we start seeing price pulling back. First thing in my mind is this: okay, we don't have a liquidity. That means if this price should continue shooting down, definitely this low has to go. All right, this low has to go. So that means price has to take out this low. But however, let's see what is going on the market. Now, boom, 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 boom. We had another break. Something I love to see. So what does this tell me? This means, okay, we have a first break, second break. By having second break right here, we now have a structural liquidity. Okay? So remember, a lot of people are entering sell. This is why I love this strategy so much. So a lot of people are like into sell. All I need to do now, okay, we have a structural liquidity right here form. The next thing I need to see is this structural liquidity to be taken out. Automatically, I can set a buy limit from here. All I need to do, price to take out this last low right here. So I'm buying from here, like below it, and I'm targeting above, having my stop loss just below the equal low. This is how you trade the equal low. All right, the equal low has to have a structural liquidity on its own, meaning that after we have a pullback, we need to have another break, two breaks, break one and break two. Now let's see what eventually happened. We said I have my buy limit, or I could wait for that confirmation. But looking at this, I had this 1 to 5 target. So let's see what happens. Let's say if I'm risking $1,000, I will make 5,000 in return. So let's see what eventually happens. Let's talk. Now, did you see that? Look at what happened. Boom. We are now in the trade. Okay? We are now in the trade. And then, just like that, we smash TP. I don't know why I'm having this slowdown on the chart. But you see how that was very easy, simple. Targeting demand zone. Just like that on BTC, we smash TP. This one is like my favorite. I trade it all the time and it works. Like it works as it, because a lot of people that are selling here are too massive. And now people that are also buying probably this low after they say they saw this break, because now they think, okay, this is the low right here. They want to buy from here, having stop loss above here. It's also massive. So if you use your head or if you use your brain properly, this is the most exciting way to trade on demand zone. In fact, one other confirmation I usually use in order to avoid losses is that when price took out structural liquidity, I usually wait to see another equal low on the lower time frame, maybe in 1 minute time frame. And once I see that, boom, I'll end. All right, just like that, TP smash. So this one is my favorite. So I want you to test that out and also tell me what you think. Now let's go down to the last liquidity type, which is liquidity number 4, order block or fair value gap. This one is the last one, which is the order block liquidity or fair value gap. And why I gave it that name is because it always happens when there is a high volume in the market. So most times you want to take a trade, but the volume is too much. Maybe you have missed your initial entry, but the volatility is too much that you couldn't enter. Order block helps you join the trend easily. And I'm going to show you how its liquidity looks like and how you can avoid it. So let's go straight to the chart. So on my screen right here, this is GBP USD. Right? Now, as you can see on GBP USD, I have my other way of trading. Like I said, I have other strategy depending on how the market is moving. Right here, like you can see right here, we had another block. I took another block risk. It was quite risky. That's why I didn't have like a bigger stop loss in case this high has to go. You get, but price then use the structural liquidity other block instead of taking out the structural liquidity because of the massiveness of the sell. So there's a high volume of sell. Now let's go straight to right here. So look at what is going on here. So we had this massive move to the downside. Now people that trade order block, what they do is right here. Now we have a clean order block right here. So the next thing that is in their mind now is they want to see price pull back to the zone so they can take a sell. Now let's see what happens if we should take a sell, having our stop above this other block right here and targeting below, probably using this zone right here, this 1 to 4. Let's see what happens. So price break that zone, and then initially looks like it was going nice, and then suddenly you are out of the market. So what happened here is what I'm going to be showing you on this video. Now let's continue. By the way, I see what eventually happened, and then just when price tap your stop loss, it still went ahead and smashed your TP. And this is the most painful part about trading. Like see that after tapping your stop loss and then it went to TP. Why is that? This one is the most painful part. Why is that? Like you can't find any reason why this happened, and I'm going to be showing you. So according to what I wrote here in my book, I said that when another block has a fair value gap above it, this is if the trend is selling. So if we have a downtrend and there's another block but fair value gap above it, price usually use the fair value gap because there is a high momentum in the market, high pressure from sellers, so we don't have a structural liquidity. In order for price to make sure that it has a liquidity to move with the continuation, it has to take out the liquidity that is above the other block. So when there is a fair value gap above another block and there is no structural liquidity, price usually takes that fair value gap as an entry. So the other block becomes the liquidity. I don't know if I'm making sense. So in other way around, if we are on a buy trend and there is another block, but there is no structural liquidity for price to take, what usually happens is that price comes back. If there is a fair value gap below that other block, price now use that fair value gap as an entry and then goes up. So as you can see from here, like if you don't know about this, you'll still be confused, like why me? Like what did I do wrong right here? So for those who doesn't know what fair value gap is, fair value gap simply means a zone where the first candle, like as we are selling, this is the bullish candle and the third candle didn't meet, right? They didn't meet each other. So this zone right here, that the candle was unable to meet each other, is what we call fair value gap. Okay, so that as simple as that is fair value gap. So what happens is that the next time you want to take a trade, always pay close attention to another block, then ask yourself, do we have a structural liquidity? And if you don't have a structural liquidity, price always and usually takes the fair value gap as an entry. So let's say I wanted to take this trade. Here is what I would have done. So now I have seen, okay, price, I would have considered taking this trade right here. But before I would do that, I have to ask myself a question. Do we have a fair value gap above this other block? Yes. So now I have somewhere I'm looking at. Then the second thing I need to ask myself before taking this trade is this. When price get to this high right here, what happened? Okay, I want to see what happened when price get to this zone right here. Because sometimes you might have something like this. It happens multiple times, and then price breaks, come back, take out this side, and then continue sell it to the downside. Like these are some strategy that I haven't even talked about. All right, we have like equal high, equal low price, take out the low, go to the high, and then continue selling. This one, like, this is the most trickiest part, but it's very, very amazing, especially for those that are trading volatility pairs. In this index pairs, this one, like, works over there very, very, very well. So now what I would have done, okay, we don't have a structural liquidity. When I would have considered taking this trade, if, as you can see, this was the low that led to this high. So if market, let's say after we get to this zone right here, this sold off and took out this high, this low right here. So I know, okay, now we have a structural liquidity. Then there is a probability of this other block holding. But the fact that we didn't have any structural liquidity, okay, the fact that we didn't have any structural liquidity, the other block has to go. So that is why the next time, if your trade goes against you after taking another block trade, always ask yourself, do we have a liquidity? Very powerful. Liquidity is everything in the market. Liquidity is everything in the market. If a trade doesn't have a liquidity, you will add a liquidity. There's this quote I always had, and it's always at the back of my mind. They say that when something is free, you add the price. So if you look at chart the same way, you are more likely to avoid so many losses. When you look at the chart, like, if we don't have liquidity, then I am the liquidity. It helps you avoid liquidities or to be liquidized. All right? So you can see, like, what eventually happened. Price tapping in that other block, and then the rest becomes history. So boom, the rest become history. We smash 1 to 4. Now, this will be the end of this video, and if you find this video helpful, don't forget to give it a like and a thumbs up. And if you have any questions, drop it on the comment section. I will always reply you. For those who are interested in joining my Telegram group, what I usually do on my Telegram or my WhatsApp is that I call a live call session, and I do analysis on the pairs I will be looking at for the week for free, like totally for free. So if you're interested, you also drop me a comment, so I will reach out to you myself. See you on the next one. As I said, stay strong. Let's make more profit. Peace.